Hello everyone and welcome to my channel. This is Random Guy on YouTube. Few weeks have passed since my last video and sadly I don't have enough time to make dedicated videos on all of the stocks I bought. Nevertheless, I want to continue to make a track record of my investing, so let's skim through new additions to my portfolio. The first stock is BXC, which I did 4 weeks ago. BlueLinx is a leading wholesale distributor of building products in North America. They have a good track record of revenue growth. However, it has to be said that the growth comes mainly from price increase of structural lumber. As the performance of the company is highly dependent on commodity prices, it is difficult to predict future growth. However, the company seems to be optimistic about future prices. BlueLinx is profitable since 2020, and it remained profitable even during the recent downturn. The valuation seems to be very reasonable, but it is quite low margin business, and if the lumber prices were to go down further, BlueLinx could easily go back to losing money. The debt seems to be well covered with current assets. The second company I picked is NXST. NXST Media Group is a television broadcasting and digital media company, quite similar to Grey TV, which is already in my portfolio. Compared to GTN, it has a much larger market cap and slightly lower relative debt. I'd say it is a safer choice of the two bigs, with lower potential upside. While I do not believe these companies are the future, the investor sentiment seems to be overly negative here. And for the medium term, the US presidential elections are coming in 2024, which should provide a meaningful boost of earnings for these companies. NXST has a strong record of revenue growth, fueled mainly by acquisitions. It is a very profitable company with good margins, growing earnings, but quite a large debt. They pay out 3.5% in dividends, and they also grow their EPS by buying back shares. In general, media companies in this market seem to be heavily discounted, and I believe that constitutes a tremendous opportunity for savvy investors. My third pick is JD. JD.com is a leading online retailer in China that provides a comprehensive shopping experience for its customers, while also offering logistics and technology services. At this time, there is a prevalent extreme negativity about China economy and Chinese companies. JD is a large-cap tech company, but it trades at only 9-fold PE, insanely low compared to US large-cap tech companies. While I agree that Chinese economy is in trouble, other companies like Pinduoduo already reported improved consumer sentiment. And while Chinese demographic pyramid is not great, that doesn't mean China will just collapse. JD has a very little debt and it pays out 2% dividend. While investing in China brings a lot of uncertainty, I believe there is also a lot of potential rewards as well. My fourth pick is GSM. Ferroglobe plc, the largest merchant producer of silicon metal in the Western world and the leading global producer of silicon-based and manganese-based alloys. Ferroglobe is heavily dependent on commodity prices, and despite this year's challenging market, the company is doing quite well. While the profits are cyclical, the company remained profitable, and the situation seems to be improving a bit. It may be silly to compare it with my first pick, BXC, but BXC is dependent on commodity prices as well. But while BXC had quite low margins, GSM has much better margins, which may provide some security if the prices were to drop further. The company has a strong record of revenue growth, not great, but reasonable balance sheet, and seems to be trading relatively cheap based on multiple metrics. Finally, this week I decided to double down on LIZI. I sort of covered LIZI before, and since then it got absolutely brutalized. And I'm not even surprised, as it is a Chinese company. It is a nano-cap with less than $20 million market capitalization, and it is basically a media company dependent on ad revenue on top of that. At this time, no one wants anything to do with Chinese stocks or small caps, and the company announced a reverse split, which can signal to some investors that they don't expect their shares to go higher anytime soon. Despite all of that, I don't see a fundamental problem with the company. Yes, they are operating in a difficult environment. Yes, the revenue was stagnating lately, but they are still insanely profitable with the potential of future growth if the Chinese economy were to recover. And the amount of cash on the balance sheet is absolutely ridiculous. They have almost $100 million in cash, while the market cap is less than 20 million. Now, in the last month or two, my portfolio got absolutely obliterated. While I am still in positive numbers and I am still above the Russell 2000 index, I am severely underperforming S&P 500 and Nasdaq. My portfolio consists mainly of small caps, and it's not like I want to focus on small caps. I try to base my investments on fundamentals, and by all metrics, small caps are undervalued compared to the rest of the market. And some industries, like for example media or payment services, are in fact priced like the end of the world is coming. I firmly believe that these companies will recover, however, this can happen soon or it may take a while. I have time on my side. However, if you want to invest, you should do your own research and do not listen to a random guy on YouTube. And I really mean it. I just want a public track record about my portfolio. I may very well be misguided in my investments, and my opinions may very well be restless. Thank you for watching anyway, and see you next time.